The question here from the mother of Arthur the dog. She's asking if borrowing and withdrawing from your Roth are the same thing. My name is Paul Vasquez with Tax Lab, and you need to become an ethical millionaire. The sun is setting right in my eyeballs. So, no, it's not necessarily the same thing. It really depends on what you actually did when you withdrew those funds. With the Roth, you can withdraw your deposits without a penalty, without a tax penalty. So, in general, it's not smart to withdraw from your investment, your qualified retirement account. The individual retirement account, Roth IRA, is a particular kind of individual retirement account. In general, it's not smart or not advised, unless you absolutely have to withdraw from those accounts because you are limited to the amount you can put in every year. So you have a max of $7,000 to $8,000 right now that you could put in for this year depending on your age. Then that's it. That's all you could put in there. And especially with the Roth, right? You want that money to grow tax-free. The more money you can put in there to grow tax-free, the better. When you withdraw that money, while there's no tax penalty, if it's an actual withdrawal, you're not borrowing from your account, your investment, personally, you have, I think it's like 60 or 90 days to put that money back in, or else that's it. You took it out and you can't get it back in. You're going to have to put in $7,000 or $8,000 every year until you're ready to retire. So while there's not a tax penalty for pulling out the principal, you can't put that money back in once you've taken it out unless you borrowed it. So most institutions that run these will allow you to borrow against it. So this some might call infinite banking, where you're borrowing against your own assets and then repaying yourself with interest. And that's what you can do with the Roth. Before you withdraw permanently, that principal, while it might be tax-free, the principal portion, it's almost better to take a loan on it, because at least then you can get it back on over time. You can get that money back in, and you would still be allowed to put your $7,000 or $8,000 in every year while you're making those payments. The interest on that, you don't lose. Whereas a credit card or a loan from a bank, you don't get that 5%, 9%, whatever interest rate you have to pay. You lose that money. But if you borrow against your Roth, instead of withdrawing that money, you can still make your annual contributions, and you can make those repayments, so you don't lose that ability to have that compound over time. Instead of investing in the stock market where you'll get a rate of return, you're giving yourself that rate of return through the interest that you're having to pay yourself through a borrowing. So the key thing to know whether or not you withdrew or borrow is, did they set up a repayment schedule with interest? If they're requiring that you do a repayment with interest, then you borrowed it. Now, interesting thing is that you can choose to not make payments back. And what would happen is if you start off with a loan and you find out you can't do the repayments, then it's going to count as a withdrawal. But at least it still gives you that option to start making some repayments, to start doing that. So if you're on the fence as to whether you should withdraw or borrow, I might suggest that you borrow. It's better that you have the emergency funds set up, the regular savings set up so you don't have to withdraw. But if you're stuck in that position, I'd really look at borrowing versus withdrawal. Once again, if you borrow, there's going to be a repayment plan with interest. So talk to that financial institution. If they have a repayment plan with interest, you're borrowing. If you withdrew it, there's not going to be a payment plan in place. You're still just stuck to that $7,000 or $8,000 a year. Interestingly, this is a way to get more money into that Roth above the $7,000 a year, but it really comes down to the exact numbers at that point, whether or not it's a real benefit as far as you paying yourself interest versus you having that money in the stock market. So it's not necessarily a great planning tool to get more money in by borrowing, but you don't want to lose all the years of contributions that you've put in if you can borrow it and get yourself on a repayment plan. Then you could still make that make the minimum, right? If you can do more, then you make the rest of the contribution for the year until you get to that 7,000. And then you can keep keep repaying what you borrow. Don't keep borrowing unless you have to, and with your interest. That's the better way to go if you're in that position. Hopefully you don't want to be in that position. Even if you started off with medical bills, it's a learning opportunity, right? To say, okay, how could I do this better in the future? Let's minimize our losses and ask ourselves, how can we do this better in the future? There are things called HSAs and HRAs and FAs, which all have to do with health and saving for health-related costs. So if it's the health-related costs that kind of got you, there are investment-type strategies where you can self-fund your medical expenses that way. And if you have a company that's making additional contributions into those accounts, now you're kind of getting free money. I'm not saying go without interest or insurance, but there are some pretty cool other strategies out there when it comes to healthcare costs, beyond just having health insurance, beyond just hoping and crossing your fingers that you don't have to withdraw from your retirement account. Get more proactive maybe. We have, for our premium members, if you're wanting to learn for yourself how to budget, we have for our premium members at taxlab.club. So our club, it's free to get into the club. It's free to get in, to ask other people questions, to ask the community questions. We might throw some answers at you for it over there. But then also, if you become a premium member, you're going to get access to our budgeting class. That is almost everything I could think of when it comes to setting yourself up for success when it comes to a budget. And you can do a lot. It's a foundational principle. If you're not willing to look at your bank account to understand where you're spending your money, you're going to have a very hard time becoming financially successful if you're not willing to do that. And in the beginning, it may seem mundane. It may seem like it's not a benefit to you, but having your finger on the pulse of your finances, learning that practice, learning how to feel that pulse of your finances will help you with that habit. It's just like the habit of savings. If you get the skill, if you get the habit, while it might be mundane in the beginning, it redeems itself in long-term, large benefits in the future. I wish you guys all the success.